Welcome back. Futures indicating a decline at the start of trading this morning as we look ahead to more retail earnings this week. The Dow Industrials right now down 86, the S&P down 21, the Nasdaq down 85, about 0.75% lower on the Nasdaq. We're waiting on Best Buy, Nordstrom, Dick's Sporting Goods, Dollar Tree, all on tap this week. Joining me right now is Federated Hermes Senior Portfolio Manager and Equity Strategist Steve Chiavarone. Steve, it's great to see you this morning.
Good morning,
Thanks very much for being here. So how would you characterize the retail earnings we've already seen from some of the larger ones? I'm talking Walmart, Home Depot, Macy's. And what are you expecting from this week's batch?
Yeah, look, the consumer looks like it's under some pressure, so you're seeing a trade down. Lower-end retailers seem to be doing a little bit better than the higher-end retailers. And you're seeing, the same amount of spend at the store, but there's less in the basket. So you're certainly getting a lot less for your money, which is consistent with the inflation story that we know. And, more importantly, the consumers are really digging into their credit cards. Up until this year, you had never seen an 18-month increase in credit cards of greater than $90 billion. We're up $197 billion over the last 18 months. So this is the biggest increase in outstanding credit balances ever, almost times 2.
Wow. So are you expecting things to get worse in 2023 in terms of the macro story?
Well, look, if you're going to get inflation down to 2%, which is the Fed, obviously the Fed's goal, you're going to need wage inflation to come down to 3%. That only happens with an increase in unemployment. So, an equilibrium labor force has 5 million less jobs, 6 million less jobs than what we have now. And I think that's where the dam breaks. Once unemployment starts to move higher, then I think you're going to see that consumer spending start to crack. And to me, there were 3 companies that announced layoffs that really have my attention. You had a trucking company, C.H. Robinson, you had FedEx, and then you had Amazon. And they all announced that a week before Black Friday. That probably tells you that there's some signs of consumer weakness to come.
Yeah, it's a great point. Let me get your take on Disney. The stock is up this morning. On this breaking news overnight, Bob Iger is back as the CEO of Disney. He'll replace his successor, Bob Chapek, after less than a year away from that role. The change following Disney's lower than expected earnings report. The stock this morning is bouncing, but of course it has traded down this year. It is down 40% year to date, and this morning showing a gain of 8.5%. Steve, what's your reaction to this stock here, as well as the news that Bob Iger is back?
Yeah, meet the new boss, same as the old boss, right?
Right.
I don't necessarily think it was a shock that Iger came back. I mean, those rumors were swirling, but the sudden nature in which they happened, clearly investors like it. A steady hand. The Chapek tenure has been, let's call it volatile at least. And I think, Iger is comfortable. The market's comfortable with him, and I think the stock's reflecting that. I think that's a stock-specific story. I wouldn't necessarily read anything through to the overall economy there.
Yeah, I mean, Dagan, Bob Iger was CEO for 15 years, and then Bob Chapek takes over. He has a big fight with Ron DeSantis after Disney tried to get involved in parents not wanting CRT in their schools for their kids.
That was one of Chapek's screw-ups, one of many. I'll point out that Disney's recent earnings announcement was a disaster, that investors, Wall Street, blindsided by how bad the results were. $1.5 billion in losses at its streaming division because of higher production, marketing, and technology costs. And even on the call, Chapek sounded he was talking about the great response to Mickey's not-so-scary Halloween party. And he had been warned ahead of the call to not sound so chirpy and cheery. Like, hello, Mouseketeers, when you have fouled up your earnings report. One of the most astonishing things, kind of speaking to Chapek's incapability of running the company, during the summer when they were talking about the theme park business, he referred to the, quote, unfavorable attendance mix at Disney World, meaning he was speaking to people who have annual passes for Disney. That is right up there with basket of deplorables. When he's talking about the unfavorable attendance mix, essentially accusing people who have annual passes to Disney as being unfavorable because they don't spend enough money when they go into the park. I'm surprised it took this long for the board to fire him.
Yeah. No, it's a good point. When Bob Iger sent the email to employees overnight, apparently many were at a Elton John concert where Bob Chapek was supposed to be introducing Elton John. We don't know if he was there, but that's when the email came in, and some of the employees were shocked by it. He writes, "Dear fellow employees, I am returning to the Walt Disney Company as Chief Executive Officer." Is this a reason to buy the stock, Steve?
Well, I mean, I think it's a reason for optimism. I mean, certainly the Iger tenure was a better one for shareholders, than what you've had over with Chapek. I mean, look, there's still challenges in the business that you need to go through.
Yeah.
You got to get streaming right. Obviously, there were some changes to the parks that weren't necessarily favorably received. So, again, I think all things being equal, the market's going to feel more comfortable with Mr. Iger.
How does it feel getting fired and the stock rallies 8%?
Yeah.
How does that feel?
Probably not so good. Steve, let me broaden out and ask you about the Fed, because Atlanta Federal Reserve President Raphael Bostic said yesterday, quote, "In terms of pacing, assuming the economy evolves as I expect in the coming weeks, I would be comfortable starting to move away from 75 basis point increases at the next meeting." The final Fed meeting, of course, is next month, December 13th and 14th. And most investors are expecting a 50 basis point hike instead of 75. What has been the effect of this tightening underway? And do you think it's priced into the market already?
Look, I think it is 50. The Fed's gone out of its way to signify 50, but I think it really is a devil's bargain. You're going to slow from 75 to 50, but we're going to go to a higher terminal rate. Whereas maybe before that was going to be 4.75 to 5. I think that number now is somewhere 5, 5.25, maybe even 5.25 to 5.5. So it's a slower road to higher rates. But ultimately, make no mistake about it, with all respect, to Fed Governor Bostic, the Fed's been expecting an easier inflation path for 2 years now. So we have to see the data continue to come in, and one data point that does not make a trend. So, at the end of the day, in order to get inflation down, you need the federal funds rate above the core inflation rate. We think that's 5.25, 5.5. And so we're going to have Fed hikes probably for the first half of 2023.
And we'll see if that is accompanied by contraction in the macro story. Steve, it's great to see you this morning. Thanks so much.
Thank you.
Steve Chiavarone joining us. We'll see you soon, Steve. Thank you. Quick